180 and when we're at that speed down to 2500.
F1, wherever you reduce speed to 180.
BlackBox.
Yeah. Hey, this is going to be fun today. Welcome to KP's Black Box. I'm here with one of my great friends in the financial services industry, Mr. Mike Hollister. And I got to give you a round of applause here. Applause. What kind of word is that? Yeah. Hey.
I haven't heard that much.
Well, how about that? Yeah. Your wife asked me to hit that button.
Yeah.
So Mike and I go back a number of years. He's been in the insurance industry for 41
years this July.
You look like 43 years.
Yeah, I do.
But you know what? You're a good-looking guy.
Yeah, well, working with producers, it puts some age.
It puts some years on you, right?
Right.
Yeah. When's your wife going to trade you in?
Never.
Never?
Met her at age 17, and she was 16.
Jeannie, you're awesome.
She is awesome.
How many years you guys been married?
I'll be 40 this September.
Wow.
Right? 1980, and yeah, it'll be 40 years. Thanks for asking. I didn't even realize that.
Yeah.
Yeah, it's 40 years.
That's a reminder. You
is.
owe me another bottle of Johnny Walker for reminding you, Jeannie.
Yeah,
I'm helping him out. So cheers today. This is going to be interesting and fun, having a conversation with you.
Thanks for the good drink.
Actually, I think you bought this bottle.
I did, and actually, I purchased it.
You did? Wow.
Myself.
Out of your piggy
Out of
bank.
my own.
Did you borrow from your life insurance policy to do that?
I did. I borrowed from my old whole life policy from way back in the day.
Wow.
No.
We're going to have to scold him for that later. Hopefully you're paying that back at interest. We'll talk about that.
I'm not as disciplined as I should be there.
Yeah. Well, look, I'm not your priest, so you don't have to confess to me today all your
I don't know
atrocities
why I
with
am
your
a priest anymore, but okay.
We can talk religion today too. That always comes
I always
up.
enjoy that.
Yeah, it is. It's a great conversation. So our podcast today, in KP's Black Box, what we're going to do is really try to make this as entertaining as possible and talk about a financial product called life insurance. And that's one of probably the most misunderstood products on the planet, wouldn't you say, Mike? It's up there maybe in the top 3 of misunderstood products.
Even if you're in the business, it's misunderstood.
Well put.
Yeah.
So everyone has an opinion about life insurance, from Dave Ramsey to Kenneth Porter and my firm, Kenneth Porter and Company, to my friend Mike Hollister here. And even off camera, we would have a conversation today about the values of that financial product and the disadvantages of that financial product. So we're going to spend a little bit of time today just deep diving kind of the KP Black Box of how life insurance works, whether you're renting it, aka term insurance, or if you're buying it, permanent life insurance. And there's a universe of products in between those two chassis, we'll call them, of renting term insurance to owning permanent life insurance. And I wanted to bring Mike on because 43 years in the business, you
41, but I'll stick around for 2 more.
I said 40. Yeah, well, I don't know what's going on. What's wrong, Ian?
Can you bring your mic closer?
Oh yeah.
Oh, okay,
Yeah,
sure.
you got to put that thing in your face, Mike.
All right,
there
sorry.
you go.
I'll lean a little.
Yeah, I know that gets a little uncomfortable sometime, having that big thing in your face.
I don't know. I feel like Sinatra.
You sing like Sinatra?
No, not really.
No. All right. So, you just recently retired from a company that in my financial services practice, Penn Mutual. You were with them for a number of years. Great mutual company that we like to use with our clients on the financial side. But before that, take me back to this young college graduate and kind of how you fell into this crazy world of the insurance industry.
Be happy to. Well, back in 1979, I graduated from a university in Philadelphia called Philadelphia University. I think now it's been purchased by Jefferson, so I'm sure they're going to rename it.
The university's been purchased.
Well, they merged with Jefferson Hospital and University because the physician's assistants have become in vogue.
Yeah,
and they had a big program there at Philadelphia University, so they're kind of taking a hospital university and merging it together.
Interesting.
And yeah, it's a really nice school, Philadelphia University, and I think it's a good match with Jefferson. So
What did you study?
I took business administration and marketing, accounting, and all those type courses.
Yeah.
My father was an accountant for at the time it was Ernst and Ernst. Now it's I guess Ernst and Young.
Yeah.
And so he
That
was,
explains a lot of your problems in life, right?
right. Probably,
Analyticals. No, that's good.
but my father always told me I should get in sales because I had so many friends growing up. So he really led me into more of I have an associate's degree in real estate and
I did not know that.
And no, not too many. Matter of fact, I just told,
so things we find out on podcasts, deep dive BlackBox.
I just told my daughter-in-law that yesterday, and she did not know that because they're getting their home appraised for a refinance. And she goes, I did not know that. And I said, well, I thought I'd be in the real estate world, and I took an associate degree. And it was during the late 70s, and the economy wasn't great. And my lovely wife at the time, she was my girlfriend, and said, well, why work? Why don't you just go for another 2 years and get your bachelor's degree? And so I went for another 2 years, and I got my bachelor's in business administration. Then came the interview process. I was actually interviewed on Action News in Philadelphia right after I graduated, because I was one of the first people to walk up and down Market Street as a new college graduate, knocking on doors and dropping my resume. And they happened to be doing a story that night, and someone at an employment agency said, interview this kid.
Yeah.
And they interviewed me on TV. And so I was right out of college. And
we were talking about a time before the internet, aren't we?
oh, 1970. I resumes. I had 250 resumes. And
Did you have the big rectangular briefcase?
I did
Flip
actually.
the little buttons and.
Well, I didn't have
Up it
one.
pops.
I didn't have one right away, but it's funny you mentioned that. When I went through, needless to say, I was hired by this company, who was also a mutual company at the time, Manulife Financial out of Toronto, Canada. And I went through a program. I'll go back to the program. But when I left that program and I got shipped out to St. Louis, Missouri, to become the office administrator there, they did give me one of those big square James Bond attaché case type looking things as my going away present. But anyway,
That's
I was
awesome.
I got interviewed with them, and I went through, I think, at least 4 interviews to get the position, because it was a national interview process that they would hire 8 to 10 of us throughout the country, and they put you in the biggest sales offices of the Manulife financial system, and you would train there for 2 years, and then they'd ship you out to an office that needed an office administrator. And I remember telling my mother, I was living at home at the time, and I said my interview with this general agent was at 11 o'clock in the morning. So I interviewed at 11, and by 11 after 11, I was in the lobby calling my mother to give her the update.
And that update was?
Well, at the time, that was only my second interview. I had 2 more after that. But she said, what are you doing on the phone? I thought you had an interview at 11. And I said, Mom, it's over. And she goes, well, how'd you do? I said, I have no clue. This gentleman asked me. I mean, he was a big shot in the industry. He led the company, or that GA, led Manulife Financial at the time 9 out of 10 years. His office was the size of our home.
Wow.
He had his own bathroom, the phone by the bathroom. It was very impressive. All, cherry furniture.
And as a
everything.
young college graduate,
I was overwhelmed.
awestruck, yeah?
And he asked me, I'd say no more than 3 questions. And then after the questions were answered, which I gave him answers to everything, one stumped me. But he said, okay, thank you. the existing office manager for him will give you a call if there's any.
Just one of those stoic interviews, like you're like, what just happened?
Oh,
here?
I was sweating bullets. I just didn't know how. The question that really stumped me at the time, which maybe would lead into other questions that you might have of me today, is he said if you wanted to find out information on Manulife Financial, where would you go to get that information? Well, I prepared a little bit, very little bit for this interview because I wasn't certain whether it was a sales job or was it a truly administrative job or what the role was. And I just remember my father, he was, an accountant, and he'd always talk about Dun & Bradstreet. I don't know why. He would say, well, I did a Dun & Bradstreet on that company. I did a Dun & Bradstreet. And I know what a Dun & Bradstreet is now. It's like, a Moody's report or analysis of a company.
Right.
And I said, well, the first thing I do is I do a Dun & Bradstreet. And I think he was impressed by that, but I had no clue what a Dun & Bradstreet is. Keep in mind, I was 22 years old.
Fresh out of college.
Yeah. And he said, well, no, I was really thinking, where would you look for us on what stock market? So I said, oh, that's just a trick question. So I figured it can't be the New York Stock Exchange. It's got to be the American Stock Exchange. And not knowing it was a mutual company, because at the time I didn't know the difference between a stock company and a mutual company.
Can you take a minute and tell folks the difference between a mutual insurance company and a stock company? I know the answer, but this is your test today.
Yeah, this is a test because, I know the difference, but to try to explain it that everybody would understand me would be, well, a stock company is owned by stockholders.
Okay.
And as the company gets profits, and a portion of those profits go back to the people that
To the stakeholder.
To the stakeholders, stockholders.
Not necessarily the customer.
Definitely not the customer.
Okay.
I mean, because the stockholders wouldn't want that to go to the customers.
Right.
I mean,
They
the
want the
product,
profits.
They want, right. So,
Understandable.
and a mutual company is owned by the policy holders, and if there is a profit, it comes back to them in the form of a dividend.
Okay.
At the time, if there was...
Is it just a dividend, or could it be like a reduction of cost, like your term insurance helping keep term insurance premiums low?
That's a very good question.
Yeah.
Yes, it could be, because you do see some of the mutual companies, as time goes on and they come out with a value-added enhancement of a product, they'll go back to previous policies. As long as there's not anti-selection, they'll improve upon that. They might add a chronic illness benefit, but the chronic illness benefit might be they might not do that without some minor underwriting. But, if they improve some mortality rates, they would make that available. If they added a different settlement option, a joint and survivor settlement, they would give that.
And we'll get into that in the show. So I don't want to. I'm sorry to disrupt your story.
No, that's all right.
But going back, so you're having this conversation with this GA general agent.
Well, his name is Len Day, a great guy.
Hi, Len.
Well, he's long gone.
He heard me in heaven.
Yes. And anyway, I didn't. You probably did a course in college on insurance, like you would, or at least a chapter. But it really never, if it describes stock and mutual, like most people in America, didn't really pay any mind to it. So he did stump me on that. But I think the fact that I did listen to my father, and he threw out Dun & Bradstreet, I threw that out there, and it worked. I got a third interview, I got a fourth interview, and the rest is history. I mean, I joined Manulife Financial in an administrative training program where I went through every aspect of a life insurance office. Now, keep in mind, back in the day, there was computer punch card systems, but there wasn't computers in the sense of you just had one on everybody's desk.
Yeah.
So if you needed a cash surrender value on an existing contract, you either called up to Toronto, Canada, or you put what they called a Twix, a message off to get the cash value, and then 2 days later, the cash value would come back by way of a computer message.
Some of these insurance companies still have, it seems, archaic systems like that they operate in. And
I don't think they're quite as bad. Oh, we also had a fiche system where you could take, there would be a fiche, a
Like a
microfiche.
fish sandwich?
Yeah, like a fiche. No, microfiche that you could go in and see the previous year's cash value.
Yeah.
So that I was properly trained, they would make us calculate the cash value by hand and then save that for the 2 days and see if it matched what the corporate head office would deliver to you. And then if it was off, you'd have to figure out why your calculation was off. So I used to calculate all the surrender values, loan values, prorated dividends, those types of things by hand. So it was a great training, and the goal was that once they trained you, they would ship you out to an office, a smaller office, and you would.
So that's why I wanted to have you on the show, Mike. Is you are and I say this with all love and due respect, but you're a dinosaur.
I am a
in
dinosaur.
the industry. You're a young dinosaur. You're not, but. And you're fit. I mean, we'll talk about this later, but I mean, you hike and you run and you want to keep up with your kids and grandkids, which is awesome. Mm-hmm. So very fit guy. But you've been around the industry for a long time, and you've seen a lot of iteration. You've seen a lot of change. Mm-hmm. If you could take a couple minutes where you went through this process with Manulife, a mutual company out of Canada that established business in the U.S. And then later became John Hancock, way later.
Well, Manulife, actually Manufacturers Life marketed themselves as Manulife Financial.
Yeah.
And then they demutualized, I'm going to say 1998, 1999. And
when you demutualize, it means they became a stock company.
It became a stock company.
So now
they went to
in
all
business
their...
for the stockholders, not the mutual policy holders.
Right. They sold it.
I know I'm putting you on the hot seat a little bit. So
No, they sold that process, and there was a lot of reservations about it. They sold that to their mutual holders as it's a better thing. It's going to allow them to diversify, grow, acquire business. And at the time, Travelers and Citicorp and all these companies were being merged together. And if you wanted to keep up with the big conglomerates, you had to demutualize. And they were very good to their mutual policyholders in the sense that they gave a tremendous amount of stock for per guaranteed cash value. As a matter of fact, at the time, it was in the, I think it's the Boston Globe, if I remember right. There was...
Zach, fact check him on this.
No, I think I'm probably going to be correct. I'm pretty sure I'm correct. At the time, Manulife Financial was demutualizing, and John Hancock was demutualized. And by the way, at the time, Mass Mutual was even exploring demutualizing. And the insurance commissioner of Massachusetts, why Mass Mutual backed out, they said, you can either demutualize. I think Mass Mutual wanted to become a mutual holding company. Okay. You can either demutualize or you can stay a mutual company, but we have no mutual holding companies in the state, so you have to do one or the other. And John Hancock decided to demutualize. And at the same time, Manulife Financial, the operation I worked for in Toronto, Canada, was demutualizing. They both happened to be run by D'Alessandros, Dominic D'Alessandros and David D'Alessandros, yet they had no family connection.
Interesting.
And the Boston Globe, going back to the answer to what you asked me there, was they put in the Boston Globe that one D'Alessandro was treating their policyholders correctly, the other was not. I'm paraphrasing here, but basically, you've got a fair amount of stock in Manulife Financial per dollar of guaranteed cash value in your participating whole life. And I funded most of my son's college education at a private college with those stock options. So for me, it did work out in a sense because of the stock options the stock I got in that policy, because I was a big believer in permanent whole life. So, but in the long run, I don't think it worked.
And can we get that recorded again? You're a big believer in permanent whole. Wow.
Well, I mean,
Because off camera, we were we were kind of going back and forth on all these different types of products and where they fit and which one's best.
Well, I mean, I think I probably said that previously. It depends on the client. So when I speak with a client on behalf of a representative, if I know they don't have the wherewithal to pay a whole life premium, but I know they need the death benefit, and let's just say it's a young father of a handful of children,
Yeah.
I want them to buy as much term they can afford, so at least he's covered.
Yeah.
If they are disciplined and have discretionary money, and we can, plow it into a traditional whole life, I believe in that.
So I want to come back to your story in a few minutes, but let's go ahead for the sake of time and our podcast today. Let's kind of break down an insurance policy for our listeners. Because what I've found in other interviews when I'm interviewing and trying to do the deep black box dive on other financial products, whether it be a mortgage or an investment or an annuity or any of these financial products that are out there that are marketed to consumers, have you found a silver bullet in any financial product in the marketplace?
I would say a silver bullet. There's bullets in all different products,
Yeah.
and one is more appropriate for the.
And I'm glad you said that, and I love the pregnant pause there, because what you're effectively saying is what I've learned in 27 years of being in the business. There's not a silver bullet. There needs to be a process that you can use financial products in a process that will,
Sure.
for lack of a better term, maybe make a silver bullet plan. An ironclad plan would be ideal. But every product has disadvantages. Every product has its advantages. So it really comes back to the structure around the individual, right? It should be customized for that individual situation. Would you agree with that?
Yeah, customize. I usually say, this product here that we're doing is the same product someone else might be purchasing. Is how we're going to manage this product.
Yeah.
So we're going to manage it. It's traditional whole life, but we're going to overfund it. We're going to offset it. We're going to put it on a reduced paid-up basis. We're going to use it for a supplemental retirement plan. It's just the same product, but we're going to manage it. So, yeah, I would agree with that.
So if we're looking at these chassis of insurance products that's in the marketplace today, correct me if I'm wrong, please. Term insurance. There's a term insurance product still in the marketplace.
Yes.
Universal life.
Universal life.
And I want to go back and kind of break some of these down. Guaranteed universal life.
Correct. Equity index.
Equity indexed or indexed universal life. Variable universal life. And in full disclosure, my favorite is a participating whole life. And not all whole lives, nor all ULs or VULs are created equally. Would that be a fair assumption?
They're quite different. You got to read all the fine print and try to figure it out.
My mom used to say, "The large print giveth, and the small print taketh away."
There you go. I think you and I have a lot of experience in the industry, and generally you can tell by the name of the carrier or the type of product. What you and I could probably figure out how that's all working. But just this week I had a no lapse guaranteed UL that stumped me, a product specialist at another company, and someone else as to how that wording, what are they really saying there, that what's really behind that
and
whole
I was
structure.
going to tell you, that was a mouthful. So a no lapse guarantee.
Oh yeah, guaranteed UL. I'm sorry, because but that's big. That's our industry. We use a lot of acronyms, and we also assume that everyone is in our same wheelhouse, the client. So that is a flaw.
So let's break that down for a minute. No lapse. What is that supposed to mean?
Well, it actually could lapse, right? So it says no lapse, but you could lapse the policy.
Okay.
But
And
what
lapse is meaning that your coverage expires?
your coverage expires because of lack of premium or lack of equity existing in the policy. There's no more equity there, so it just has no more value.
So the consumer's death benefit that they may have been purchasing, or all the features and benefits in that contract, are now gone, and you no longer have a relationship with that company.
Gone, baby, gone. You have a point in time of roughly, normally I'd say 30 days, but you have roughly 45 days to reinstate that policy without evidence of insurability. But once you're beyond that, all bets are off.
If you want to reinstate the policy, you could do that, but it may take
go back through
medical underwriting,
yeah,
and
so
things may not be what they used to be.
I dealt with one of those this week. In that, a woman lapsed her policy, and she's coming back 11 years later, and basically once she told me all her issues in her life, I said, we really have to go down a different path, because there's just no way you're going to get coverage.
Right.
But bring me back to what
the no lapse, if we're breaking down these products.
No lapse, the guaranteed no lapse. Well, it's no lapse in that the insurance carrier, whether it's a mutual company or a stock company, is promising, if you do X, we will do Y, which means this policy will never fall apart or lapse on you, and the death benefit will be there. And the X being you're paying a set guaranteed premium, either for the entire life of the contract or for a duration that might be me with the table there. I'm sorry.
It's bass drum going.
Yeah, I'm pushing down. It would maybe, would not lapse if you pay the set 10 payment, 15 payment, or pay for a life type product. So that's really.
So we see that happen a lot in the industry, is that a client has a perception that their insurance is going to be there for their lifetime, or for at least a period of time that they have preconceived based on how maybe an agent had proposed it or sold it years before. And what I've found is that people will try to set it and forget it and just not even think about it anymore. And then years later, when the conversation comes up or a review happens, and then they find what I call these uh-oh clauses, like, I didn't know that was in there. I didn't know that was the language. And then the agent ends up looking like a schmuck, and sometimes many of them are. It's the responsibility of both people. One, the agent, to be able to give full disclosure and make sure that they're understood, not misunderstood. Right. But the consumer also has a responsibility to understand what it is they're purchasing. And so I remember in the book, I think it was The Lexus and the Olive Tree by Tom Friedman, he had this statement called systematic misunderstanding. And I think that happens a lot in the insurance industry, because there's this nomenclature. And we expect these consumers who've never had a finance degree or never had an insurance course or maybe never had an investment course, and we throw all these big words at them.
Right.
And this vernacular that we expect them in one or two meetings to understand. So part of what I want to do in these podcasts is really just deep dive some of this nomenclature. And I knew having you on today, I was going to have to stop you and go, okay, Mike, no lapse guaranteed universal life.
Yeah, we all do it in the industry. We just assume everybody is keeping up with it. I guess just like a physician would say COPD, and you're just supposed to know it's chronic obstructive pulmonary disease. We do that.
Wow.
It would happen to any fighter.
I didn't mean to hit that button.
What can I say? Hydrogen bombs.
Yeah, you're throwing hydrogen bombs on us, man.
No, it's just like, and I know I do that a lot, and we all do that in the industry. We say offset or no lapse guaranteed, but I kind of stay in my lane, and this is my lane is life insurance. I'm getting off topic now, but I have a lot of siblings, and they always ask me everything about insurance, and I keep having to tell all my brothers and sisters, I'm a life insurance guy. I don't know anything about property casualty. I'm really not an annuity guy.
Yeah.
So you get your expertise, and then it is what it is. But going back to the differences of products, or we're starting to go down that path. Again, I went for business administration. I'm not an actuary. People from my high school algebra class would laugh that they heard Mike Hollister talking about numbers and mathematics. But you learn to survive and
Or
learn.
your dad would be in the accounting. Right?
My father would also. He would be blown away. That, wait! I got all these kids and Michael's talking math. But it starts with forgetting term insurance for a second. And, permanent life insurance.
And permanent should be by the name. Does that mean it should last your entire life?
Yeah, permanent life insurance should be permanent, so
Right.
that when you die, that death benefit is paid, no matter whether you die
To a beneficiary.
To a beneficiary.
Okay.
Well, the industry starts everything that's permanent. People think is whole life, or you talk to a client. I'm sure you have this experience. Oh, I have whole life. I said, well, do you have whole life, or do you have permanent? And so we've gone down that
Because
path.
universal is a permanent life insurance
policy.
contract. Variable universal is a permanent life insurance contract. Guaranteed universal is a permanent life insurance contract. But it doesn't mean that it lasts all the way out to actuarial tables of 121 years.
Correct.
Which is our current mortality tables,
table.
right, for the
Yeah.
industry. Which you'll probably make 121, Mike. So
Well, my mother's 92, so
Yeah, that's
is she
awesome.
92? I think, 92.
That's great.
So she's in great shape. I don't think I'll make it that long. But anyway, there's really only two types of life insurance. There's
Yeah.
term and permanent.
okay.
And then under the term umbrella, we have 1-year term. Some people call it ART, annual renewable term, 1-year term. We have 5-year, 10-year level premiums. They're either convertible, which means you can, without evidence of insurability, say, I want out, I want to go to a permanent chassis type now, and those carriers let you
And you can
that.
do a conversion or a switch over
without going through
the
underwriting.
nurse showing up at your house or asking for
Right.
blood or urine or any of that crazy stuff
Yeah,
in
and-
order to qualify, and all the embarrassing medical questions that go along with it.
Yeah, it's
right?
getting stuck with blood and
Right.
you know,
And that's changing in the industry now too, right? Where these crazy physicals that you used to have to do
it's amazing. I would never in a million years
Yeah. So
thought we'd come this far that
we can thank Google and all the big analytical technology firms that have brought data to the marketplace at the snap of a finger.
it's amazing.
It's scary what the internet knows about you and I. Zach, let's look up some stuff on Mike Hollister and see what we can find out.
I don't think you'll find much on
Really?
me. I'm kind of a under
You're
the
that
radar.
dinosaur again, right? So you'd have to dig deep, right?
Well, there's no Facebook. There's
Athlete in the CrossFit Games.
Athlete in the CrossFit game. Wow.
that would not be me.
It's your doppelganger?
That is. That is. And I wouldn't know what that was, except my son used that terminology a couple years back on a fella, and he does look like me. So
That's funny.
Yeah.
All right, so we digress there, but
So what I think consumers should know is that, and I think they do realize this, but every single product out there is filed with the insurance commissioners of each state.
Yeah.
So if we're talking about a whole life product, that whole life
so
product,
insurance is regulated by the state, not the federal government.
I guess the rules are around the mech issues would be regulated by the
By the
federal government.
feds,
But
right.
you're right; it's state approval by the product.
The
So when
Internal
it's-
Revenue Service sets the rules in terms of how taxation works,
Right.
but the states regulate
What's
what
a-
companies can do business, and what
and
type
that's
of
it.
products they can sell to their
clients.
clients within that state border.
And part of my role somewhere in my career was trying to get those products approved for different carriers in different states. So I'd been down to the insurance commissioner's offices in particular the state of Connecticut, because a good portion of my career was up there in New England. And whether it's Manulife Financial, Penn Mutual, I represented Transamerica, different carriers, they're all filed with the insurance commissioners. So generally, if I'm speaking in front of a client, I would tell them that this product is filed by 49 insurance commissioners. The reason I say 49 is a lot of times it's a separate product for the state of New York because they're a little weirder about product approvals.
Hey, easy on the New Yorkers there. Come on.
Well, I mean, they just are. Usually, you'll see the carriers will have a separate company.
They're complicated.
Yeah, they're they just have
Complex people.
It's a little, I don't know, a tougher system, but it's for the most part. So I go through that XYZ is calling this product the Protection 2000 product, so it's kind of like the Ford Focus or whatever. It's okay.
Yeah.
So it's a universal life product called the Protection 2000 whatever, but it's really filed with the insurance commissioner as a flexible premium life product.
Okay.
Or it's filed as a traditional whole life product, or it's filed as a flexible variable life product, a flexible index product. So, and then there's the names that the insurance carriers put on it. And then I would explain to them the differeces or the risks and the rewards. But it's essentially, there's an actuary who's far smarter than me analytically that they priced for this risk how much you have to put into this contract to be there, hopefully, when you're 100 or 121.
Which they would refer to as the cost of insurance or a mortality factor, like pricing the probability of someone living or dying or dying too soon compared to their class or their group.
Right. And it's more than just mortality because they're going to, price on how many of these policyholders that are sold today are going to let these policies wither away or lapse. Mm-hmm. How many are going to take maximum loans and suck all the cash value out of it so eventually it lapses. So there's all kinds of pricing in it far beyond my expertise, but they make those assumptions.
Yeah.
So when I'm describing a flexible premium product, some actuary has to sit there and say, of this book of business that we're selling, how much of it is going to stay on the books and how much of those policies are going to be funded at the right level to stay on the books.
Okay.
So the flexibility is really on the client, not the insurance company. You have to fund it, the flexibility if you want to fund it. So I would go into, the pros and cons of that if somebody were asking me about.
So, thinking about the industry as a whole, and we went back to there's different types of products from the term to the universal to the variable universal to the permanent life insurance that most people think of as the whole life chassis. Those are issued by different companies. And just as a side note, guys, we got to fix our table next time. I'm doing the annoying sound here. So these products are designed by a company's product design team, actuaries, portfolio managers, and they come together to issue these products through the states, through the state insurance commissioners, and they get approved at the state level to be able to be issued in that state. So now we come down to, okay, we've got this product that's available in the marketplace, and as an example, like here in Virginia, you have a term product. Is there a maximum number? So if I wanted to buy some term insurance, is there a maximum that a person can get?
You're talking about coverage, total coverage?
Coverage, yeah.
Yes, there's a maximum. You have to have financial justification, and so there's a max set by, the insurance carrier, but I also believe that's set by insurance commissioners on insurable interests.
Okay.
They're insurable interest rules.
Okay.
So a lot of times when you have somebody that want to buy tremendous amounts of face amount coverage, the carrier themselves can't write it because it would be against the law. There's not enough insurable interest on that person. And so they set it based on their net worth, their annual income, the value of their business, and there's parameters around there. And I would suspect, again, I don't price products, that some of that is set by the reinsurers that help support the carrier that's also taking the risk. They're telling those carriers.
Reinsurer, meaning there's someone out there who's in the business of shoring up each insurance company by assuming some of that mortality risk, but they want some of the premium,
Right.
some of the profit. So there's this term that's been around for years called human life value. And it's probably going back as early as I've ever researched into the early 1900s. And there's this economist named S.S. Hubner who talked about human life value. So that's still used today. It's even used in trials when there's a wrongful death of an individual. A court will try to calculate or have an expert calculate human life value of an individual. And so a lot of folks, especially the guys that I work with in my industry, like to start with that in mind, where we use this human life value approach when you come to the purchase or the renting of an insurance policy, where if we can get the max
Right.
and minimize the cost, why wouldn't you? And so when you think about that, Mike, as it relates to coverage, a lot of times you'll see guys in the industry who will give the client the opinion through some needs analysis of how much insurance a person should buy. What do you think about the idea of using human life value as that calculation, saying what's the maximum that an insurance company would issue you, and then ask the client, well, of the maximum, how much do you want? Do you subscribe to that type of money philosophy? What's your opinion there on the calculation of how you go about what should I buy? And I hear that all the time. Well, how much should I have?
I think you got to educate the client on that. I mean, it wasn't the insurance industry that came up with, after 9/11, the value of all those executives that perished in the
World Trade
in the
Center,
World
yeah.
Trade Center. I mean, it came up. I'm just remembering headlines. It's 2.1 million, 2.4 million per life. So I don't think people view that they're walking ATM machines. If you're working and you have a career and you're able to make a very attractive income, then I do prescribe to that. Then you get down to, do they have the wherewithal to pay for it? Do we buy a portion in term insurance? Can they discipline themselves instead of buying the next new hot car to put some money into a permanent whole life type product versus. So you bring up a valid point here, is that most people look at insurance as a pure cost, as an out-of-pocket cost, as an expense to their cash flow. But if properly funded right, sometimes you could use assets or maybe dividends or gains or capital gains that would otherwise be taxed. There's strategies there that could be used to fund paying for or making premium payments that don't necessarily disrupt your cash flow. Right. And so when we're thinking about these products and what you've run into in the marketplace, being that you've been around the business for 41 and I tried to make it 43 years, you've seen a lot of rule changes happen in the industry. What I'd like to bring you back to is around 1983 and 1986, there was this rule change in how, we'll call them the Rockefellers, how these wealthy people would make premium payments or make contributions into their life insurance policy through this technique of overfunding, giving the insurance company more than what was required. And many times they would do that with a single premium life insurance policy prior to 1983. Right.
And can you address that and why folks would do that back then, and what that concept was used and how it was utilized?
Well, it's arbitrage. They're putting that money in and getting a fairly safe yield on that. I mean, it was a very safe yield.
Very safe yield,
but not an aggressive yield.
Yeah.
But then they had the leverage on the death benefit of it being coming to them income tax free by the definition of life insurance. So you saw them putting in $500,000 to get $1.5 million of income tax free death benefit to their heirs.
Yeah.
And that arbitrage or that leverage, eventually the IRS said we
They said, hey, time out.
Yeah,
we kind of understand what you wealthy people are doing.
And they put some parameters around it, thus the modified endowment.
So there are two acronyms, the TAMRA-DEFRA Acts, those tax reconciliation acts.
Were you in the business then?
I was coming into the business right at the tail end of those massive changes.
Yeah, I was a little younger. I mean, I would have only been in the business 4 years. I remember it really did devastate, our sales force at the time. And we did have a single premium product. So I do remember all that.
So what I remember, and going back in the way I was taught by an economist to fund these contracts, was if the IRS sets limits on insurance carriers for what's the maximum you can put into an insurance contract, and that is designed across no matter what U.S. company or even a company that's maybe in Canada licensed to do business in the U.S., that there are guidelines that the Internal Revenue Service sets under these tax acts that gives the consumer a guideline and the insurance industry for what an insured or a premium payer can put into an insurance contract. And that's typically referred to today as the MEC limit, Modified Endowment Contract.
Right.
So today, what are you seeing with consumers today? Are people still buying insurance the old way, like they're buying term insurance or renting the coverage and then letting it go away and the death benefit goes away? Or are you seeing folks lean more into that, hey, you know what, I think I actually want to own it and I want it to be here over my lifetime? What do you see? What's kind of your pulse on the economy?
It's just my opinion. I find disciplined buyers are buying permanent life insurance. I mean, they're disciplined. They're disciplined. And then if they're even more disciplined, they're buying traditional whole life. If they like the word flexibility, you might see them buying an index universal life. I don't see a lot of variable life sold, which we went through a crazy period of that.
And that variable life is just a contract that allows the policyholder that if they want to have access to underlying investments like mutual funds, they're able to buy these variable contracts, and which means the death benefit and the cash value vary based on the performance of the underlying security.
Yeah, the policyholders take the risks of the investments, and they're segregated accounts. So instead of calling them mutual funds, they're segregated accounts managed by the same name brand fund managers, MFS, T. Rowe Price, Fidelity, Templeton, and they go in step with the insurance companies to deliver that. And every financial institution takes a piece of the pie. So, T. Rowe Price is going to get their fee. The insurance carrier is going to get their fee.
So
but you're
it could
basically
be one of the most expensive ways to buy an underlying investment compared to maybe just going and buying that investment straight from the fund company or the ETF. So there's some underlying expense that you have to be aware of there.
Well, when it first came out in the mid '80s, it first came out. It might have come out earlier than that in Europe or Great Britain, or I'm not sure when it actually came out. But you had insurance companies that historically took that money in and managed it, and then delivered dividends or profits to stockholders. And now the public is clamoring because the markets were going crazy for access to higher yielding investments. So you put the different mutual fund managers into your chassis of life insurance. Yeah. Well, where that money was once sitting in the insurance company's coffers and letting them to manage, it came in through here and then went back out to T. Rowe Price or Fidelity. Well, insurance companies don't want the cash to come in and then just leave and just become a administrator and taking mortality risks. They want to be able to manage that money as they see fit too. So there was more charges on them, so they got their piece of flesh.
Yeah.
If you is a way of me saying it, I don't know whether that's they got their profit, and then T. Rowe Price or Fidelity got their profit. So it actually
Well, insurance
was
companies
very
are
expensive. It got very expensive. And I remember a fund manager gentleman, really sharp guy, a UConn graduate, and he said, Mike, I'm not selling variable life. He says it's just too fat now. Let this industry go through some process, and then I'll come back to it down the road. And he actually was right, because then it kind of the bloom fell off the rose a bit when there was bad performance in the market.
It brings the thought up for me, the way I was taught as a young advisor, putting that hat on for a minute and having that conversation with my clients and consumers, is that the way I was taught was that insurance companies, banks, mutual fund companies, money managers have 4 rules. Number 1, they want our money.
Sure.
Number 2, they want it on a regular and ongoing basis. 3, they want to hold on to it for as long as possible. And then 4, when you and I want some money back, these institutions want to give us back as little as possible. And as much as I love insurance and how it can work inside an overall strategy or plan, we have to be aware that they're also a financial institution, that
right.
As you said, there's some fat in there. They have profits. We need them to be profitable in order to be in business to pay the underlying death benefit, or you wasted your money.
Right.
But what I've found is that if there's a way to manipulate those rules for how they benefit you as a consumer, then you can win in that relationship or in that partnership with an insurance company, which is why I think you and I have a high favor of mutual companies. And not that there's stock companies are completely horrible, but I do like the idea that with a mutual carrier, I have an opportunity for them to pay a portion of those profits back to me versus the stakeholder and me being the policyholder.
Right.
And there are probably 10 carriers in America that I would tell my clients to look at and consider as mutual carriers. And I'm not going to promote any of them today. We'll do that on a different podcast where we'll talk about them. But when it comes down to the design, and we go back to this rule change of 1983, 1986, if you want life insurance to stay on your balance sheet for you, selfishly as the consumer,
Right.
if you want that benefit to be there for your entire life, you and I have had these conversations for years and even off camera today, the most efficient way to do that, in my opinion, and how we design them, is this feature of overfunding, meaning you're giving the insurance carrier more than what's necessary for the underlying death benefit if you were renting it, or
Right.
AKA using term
You're
insurance.
just sticking more octane in there initially, yep.
Yeah, and what that does to a contract is that it turns on those dividends in year 1 versus in a lot of contracts, it doesn't turn the dividend on if they're not funded properly until maybe year 4 in
Right.
many insurance contracts. So the design is more important than the product, I would say, and sometimes. So your process, how you design that product for how it fits your individual wants and
Right.
needs. Would you agree with that? And
Well, I certainly agree with it. I mean,
we're
that's
on camera here. You get a chance to object to my opinion. So
Well, I don't think it. I think that's a sound opinion. Is that the design is really the key to it. I mean,
Yeah.
it's when do you want to put that money in? When do you want to stop paying premiums? Like I said earlier, I can't remember whether I said it here on the podcast or before we met, is that you have to manage the policy once but it's the same contract that that the next person could buy. It's just how you want to fund it and when you want to put that money in.
yeah,
So a carrier is going to build a product that will stack up against its competitors. But if you want to overfund it early, and then have that in cash value accumulate even quicker.
Yeah.
They have built chassis or mechanisms where you can upfront some of those premiums and costs, and then you have that you're taking advantage of their performance of better mortality, better yield, keeping their expenses under control, all those.
And if funded properly, Mike, the access to your premium and to those dividends, if you follow the tax rules and if you follow the guidelines that the Internal Revenue Service has put in place, there's access to your cash and dividends inside the policy through a couple of different features, right? Surrender of basis.
Surrender, you could
Policy
change.
loans?
You could change your dividend options to be paid in cash if you didn't want to accumulate. You can do that at any time, or you could take policy loans. And generally, most carriers will have a very attractive loan provision after you get through some of the earlier years. Usually, it will kick in by the 6th or 11th year. They'll basically you're borrowing from yourself. You hear these, you be your own bank type expressions.
And I want to be careful with our listeners out there that when you're borrowing money, you're not really, we use that term in our industry a lot, but there's a misnomer there. We're really leveraging our policy. We're borrowing the insurance company's money off their balance sheet, leveraged against the cash surrender value in our policy. And I know it sounds like semantics there, but when we do a policy loan, it's the insurance company loaning us the money off their balance sheet,
Right.
general ledger, but it's leveraged or a lien is placed against the cash surrender value of our policy.
Correct.
And if the person dies, that death benefit
It's gonna be
pays the
reduced.
loan,
Yep.
income tax free in most cases.
And that's why they're not getting the 1099-R. I mean, it's a
Right.
loan. It's a loan.
Yep. And the surrender basis is just a return of your after-tax dollars that you'd use to pay this, so it becomes tax-free. You're not getting taxed on those dollars again. So there's benefits there that really need to be examined and how that compared to maybe being somewhere else on your balance sheet or looking at insurance in some cases. I've heard some people refer to it as an additional asset class. Like you have equities, you have bonds.
Right.
And if you can understand the use of life insurance as an asset class, and Zach, remind me, we'll add a report to this podcast today by one of my professors that were at the American College, Dr. Wade Fow. He wrote a great report on looking at life insurance under that scope and did some really great comparisons. It's a really, I don't know if you've ever read it, Mike.
I think you sent that to me.
Yeah, it's a great academic read.
Mm-hmm.
A little weighty, and that disclosure.
Yeah, I
to
remember.
the
I remember when I do believe you shared that with me.
But it helps validate, or maybe even answer questions for consumers in that, should I use a permanent life insurance policy or a participating whole life policy in my overall retirement strategy or retirement plan? And what we have found over and over and over again with our clients in our firm is, overwhelmingly, it's a product that should be considered in their overall process. And sitting down, having these conversations with you helps me validate that a guy like you had been around in the industry for 41 years, and you've seen products come and go. You've seen industries change those products, but there seems to be two core chassis that are out there that haven't changed a whole lot in 100+ years, and that's a plain old chassis of a term insurance policy,
Right.
and the plain old chassis of a participating whole life contract. And participating means that there's dividends being paid to the policyholder inside that contract that can grow tax deferred, access to it tax free if you utilize the contract, right?
Right. And then you add to it now that with the turning down of the economy and where to put your money in a safe spot, where can you go that you're going to have a guaranteed growth?
Yeah.
And these products are priced at 4% underlying guaranteed rates, which is phenomenal. I mean,
Yeah.
I think you mentioned,
And what's reversed out of that is mortality costs, right?
Mortality costs.
age,
But
yeah.
it's going to
Okay.
be filed in 49 states with a guarantee rate of 4%. You're going to have it. You just talked about there. We talked about there with the loans. You can
Yeah.
access policy loans on a very favorable basis. You got income tax-free death benefit. You got now have a chronic illness benefit, so now attached to them, because if someone's chronically ill, the insurance carriers will all let you draw down from that death benefit prior to death if you have a
Yeah.
chronic illness, and you never receive a 1099-R.
That's interesting for folks to take a look at. If you're listening today or if you're watching us, if you have a contract issued prior to 2008,
I would say 2009. Most institutions, the IRS now allows you to, the insurance companies, to price a chronic illness rider on those
into the
policies
contract.
up
Yeah.
to the IRS per
So
diem.
it's not
which
an
is,
additional cost. It's priced into the overall chassis of the
right.
product.
It's like a wiper on the Mercedes headlights. It just comes with the vehicle.
Yeah.
I mean, and so this is coming with the permanent product that as a buyer, someone's going to receive this benefit.
Yeah.
You're either going to receive it as a chronic illness benefit, you're going to surrender it or annuitize it, with a settlement option, or you're going to pass it on to your heirs.
So if you have a contract issued before 2008,
the wording's
there was no chronic illness rider. Accelerated death benefit riders were maybe in a few of the contracts out there.
Yeah, there's an accelerated, which is you're going to access if you're terminally ill within the next year. You can access 50% of your face amount early.
So, speaking to those riders, other things that consumers should be looking for, especially if you're going to try to maximize your internal buildup of cash value and maximize the death benefit over your lifetime. If you're a young person in the early premium paying phase, and where you're making these contributions, premium payments to an insurance company, if you're younger than 55 years old, a lot of companies have a rider that is an additional cost, but something they should consider, and that's a waiver of premium rider.
Yeah, that would be an extra. It's not going to be hidden. It's going to be actual additional cost.
Line item costs. In your contract.
Exactly. And it's going to waive their annual commitment, their premium, if they become totally disabled.
Yeah.
Which is a really nice feature to have.
So where else can you have a savings plan on the planet that you could have a waiver of your savings
Right.
if you became permanently disabled? And it's important to look at the definition of disability in these different contracts.
Most of your major insurance companies, the 10 that
The
you
big
mentioned, the
mutuals,
big
yeah.
mutuals,
Yeah.
they're all going to have terrific definitions that, if they're totally disabled, that premium's going to be waived for the rest of their life. And, I ran into a gentleman, actually was an engineer from one of the big chemical companies,
Yeah.
DuPont. And he purchased whole life insurance for his 3 sons. And he's purchasing some from Penn Mutual. And I said, do they have any existing coverage in force? And he went through and he listed probably 3 or 4 of the major mutual companies that you and I would bring to the table. And he had waiver premium. I said, can you tell me what are you doing this for?
Yeah.
And he said, well, I've been very fortunate in my career that I have worked for an employer that's going to give me a defined benefit plan, that I have a defined benefit I will get when I retire. And I have no confidence that my 3 boys are going to have the same thing. So I'm building a defined benefit plan.
Yeah.
And because of the waiver on it, it's contractually guaranteed.
Yeah.
So that when these young men, become adults, they might have their 401k, they might have their portfolio, whatever, but he's built them permanent. It was actually a brilliant concept, and he did it all on his own. And I've actually stole that idea a bit and shared it with individuals. That why not for somebody young like you just talking,
Yeah.
if put a waiver on there. And now they have, if they're disciplined, they're paying that premium, they're going to have that guaranteed nest egg there, which would be their defined benefit plan.
You know, it's interesting you bring that up because it made me think of your son-in-law who works for the FDIC.
Yes.
And they're regulating these banks. And one of the line items that banks are required to disclose is where and what they're doing for their officers, and they're highly compensated. And you can go to fdic.gov, pull up any bank's financials that you want to, and in full disclosure in their financial, you'll see a line item for executive life insurance that sits on their balance sheet.
Right.
That's there as a benefit for these executive officers in the future when they go to retire as a non-qualified defined benefit plan.
Right. And more, you're seeing those programs go back to traditional whole life because they did do those in the late 80s with this flexible premium type policy, and they're coming up short. Where, you know, I've taken what this engineer, he said, look, Mike, this has contractual guaranteed values here no matter what. So if you go down the line there and you get to this young man that's 21 years old, the father's funding it, when he gets to be 55, 57, there's a pot of money there that's guaranteed.
Right.
As long as it's from, you know, a AAA rated company, you know, I'm assuming
a quality company.
A quality company, you know. So, and that's all he basically put his sons with. And I thought, and now with adding what you said about waiver premium, if something were to happen, they could waive that premium, and it's still going to be funded at the same level. And so that.
Well, I have a personal story to that. 1997, one of my close friends, when I started at a captive agency early in my career, buddy of mine moved up from Miami, had some professional sports players and some professional physicians, doctors. Mm-hmm. And one of these doctors was a neurologist. This neurologist, oddly enough, ended up with MS.
Oh, my heavens.
And actually had, I think 5 years prior, bought a permanent life insurance contract from my buddy, a guy named Tim. And Tim said this guy ended up buying waiver of premium inside his contract that we would refer to in the industry as being max funded, meaning he was putting the maximum he could into the contract, into that policy based under IRS non-MEC guidelines, modified endowment contract. And long story short, what ended up happening is around year 5, this neurologist of all people came down with MS, could no longer do brain surgery. But what ended up happening is the insurance company continued to make his premium payment of $75,000 a year.
Wow.
Big number.
Yeah.
But it doesn't matter if your premium $75,000 or $7,500 or $750. If you have a waiver premium rider, and if you're under age 55, I would say, hey, that's something to really consider looking at.
It's so reasonable.
In your right. It's really inexpensive that you add this rider to your savings.
Especially if you're using that vehicle really to accumulate cash. If you're disabled, that's...
Yeah. And one of my best friends, a guy, had a big paint contract company, and he was my first death claim. It was horrible. But the guy ended up with stage 4 esophageal cancer. Am I saying that word right? Esophageal cancer. And hit him like that. It was just snap of a finger. 2 years prior, he was top of the rating class, had what we would call in the industry a preferred plus rating, super healthy, bodybuilder. And 2 years later, he's diagnosed with a terminal illness.
Right.
6 months later, passes away. But during that period, he had waiver premium on his contract. Going all the way back to when that diagnosis happened, the insurance company waived that premium. And his family was taken care of in a big way.
You don't see insurance professionals recommended as much as it should be.
Blows me away for young people.
Really, I think everybody's just gotten lazier.
Yeah.
But to explain it, but it makes sense, especially if you're you're going with a really strong permanent policy, and you're with a paid-up additions rider that you're sticking some additional cash in up front in the first year, the first 5 years. Why not put the waiver premium on it?
So if I can, bring it back to Mike personally. Off camera, we were talking, and you've been a great steward of your own industry, and you shared with me a little bit about personal stuff you were doing, and I won't give people numbers, but you've had one of these funded policies for years that you've been putting premium into and putting money into, and we were talking about that yield, and I don't want to throw numbers out, but it's substantial, the return on cash that you're getting from the premium payment that you're still willingly paying today.
Well, I couldn't, I didn't even know you were going to ask me that before the podcast, and I'm racking my brain to figure out what the premium was. I purchased that policy. My son turns 33 tomorrow, and that was 1987. It was somewhere around then I purchased it. It's when most people, buy their coverage, is when they either get married or a mortgage, or they have their first, child. You really don't get serious about life until you bring somebody else into the world. And I just remember I bought a permanent whole life plan, and just going by memory, I think it was $3,000, $2,800, something like that. It wasn't a huge face amount. And
today, 30 some years later, beginning of your premium is $3,000. Your guess, and I'm not holding you to this.
I'm saying
this is not verified, but
I'm saying the contractual guaranteed cash value is probably increasing by $3,500 a year.
Wow.
Or maybe more.
Plus the dividend. Wow.
Plus the annual dividend. And that did take me through. I did do some borrowing. I think I shared that with you. When my wife had a great job with the federal government, and when we had our daughter, our second child, I'm one of 9 children. I have 4 brothers and 4 sisters. My mother.
Sound like my mom and dad. My mom was one of 9. My dad was one of 9.
Really? Oh well, my mother.
27 freaking kids between our generational. Wow.
So my mom had 9 children. When my youngest brother went out to first grade, she went out to work.
Yeah.
And one of my older sisters kind of managed the house when she was still working and we're coming back from school. Anyway, I'll get to my point here. But she had 9 children, and she ended up being the head purchaser for the Institute for Cancer Research in Philadelphia.
Wow.
And she retired with a higher pension than my father, who was with Ernst & Young, and he was an accountant for all his life. So when we had our second child, I said to my wife, I said, listen, you do whatever you like, but if you want to stay home with the children, we'll figure out a way to make this work, right? Because she was making a good income. But I said, I just don't want you to wake up when you're 40 or 50 years old and the raising the children went by and you missed out on it. I said, you can have it both ways, because my mother had 9 of them and she had it both ways. I mean, if you plan accordingly, you can do both. You can be a career person, and just by luck, I did better in my career. But initially, I racked up some policy loans to go from earning 2 salaries to not having 2 salaries. So I did tap that whole life policy, and I still do have a loan on that policy of something that I should pay off, which I will pay off.
Thanks for confessing. We'll work with you.
Yeah, right. But I mean, that's the beauty of it, is that when it's appropriate, you take the loan. I've always paid my premium. I didn't not pay a premium to create that loan, which happens a lot of times. People don't pay their premium. And inside that policy is a non-forfeiture option that allows it to automatically borrow, and then you wake up and the policy lapses. No, I have a loan and I pay the interest, and I just have not moved enough money over to pay it off.
I'll work on you with that, Mike.
Yeah,
we'll beat you up on it. But no, that's one of those features, and thanks for sharing that personal story. And I think so often consumers look at their insurance as a cost versus a cost recovery. And even though you're still paying a premium today, it sounds
I
as
don't
if
have to pay that premium. I mean, I could
Yeah.
pay off the loan, but you're right that it would offset. It's
Yeah.
strong enough, the annual dividend, to pay that premium.
Yeah.
I think it's just, I'm just used to paying it.
Yeah.
You know.
And it's probably that 41 years of just ingrained in you that you're doing something that is not only for you but for it's a deposit
Well, the other
to the legacy.
Right, the legacy, and if I spent this long in the insurance industry, I certainly want to make sure I have permanent life insurance to leave to my heirs.
Sure.
You know?
Yeah. How cool.
Because I believe in it.
We were talking off camera too, and we want to try to close out the podcast. I always ask folks, what they're reading right now, or what's on your kind of your top list of things to read. And I thought it interesting that before all this stuff that's happened in society, and at the time we're recording this, we're still going through a COVID-19, and we're in phase 2 now. Mm-hmm. But throw on top of that social unrest, where we had just some horrible things happen to some folks in Minnesota and down in Georgia, and I can't remember where the young lady is from. I'm sorry, but just some bad things happen in our society where people were unjustly, what appears to be right now,
Right.
Unjustly, their lives were taken.
Right.
But that was interesting. That correlation is that there was a book that you're getting ready to crack open called "The Conspiracy of Lincoln."
Yeah, my wife asked me, what I wanted for Father's Day. You like a good book while you're sitting on the beach, and I said I'd like to get that new book by Brad Meltzer.
Meltzer, yeah.
Yeah, a Conspiracy of Lincoln. There was actually a conspiracy when he was first elected. As you remember, there was 3 candidates at the time, and he didn't win with the majority. I don't know whether he had 30-some% of the vote. I'm really not a historian, but my wife and I did take an evening course at University of Richmond on Lincoln because we found him interesting, and the president of University of Richmond at the time was a scholar on Lincoln, and he brought people in from Great Britain. I don't know whether you realize, but Lincoln is, other than Christ, there's been no one would have been written more about than Abraham Lincoln.
I did not know that.
Yeah, and that someone shared that to me, which is pretty fascinating. And I just was in the car and listening to a radio program, and someone came on and started talking about this book, that there was a conspiracy after he was elected, well before John Wilkes Booth, that he was going to be assassinated. And that was before the...
I got to read this.
I did. I was fascinated by it. I said, really? I said, so my wife asked me, what do you want for Father's Day? And I said, listen, I don't want you, if you can find a used book, go on Amazon. I don't know. But I said, don't spend a lot of money. But I said, that's what I'd like to read this summer while sitting on the beach. And I just find that kind of stuff fascinating. If I do read books, I generally do read kind of nonfiction kind of stuff. And
there's enough boring insurance stuff in your life that you need a...
Yeah, I guess so. I guess so.
So we'll put that link in the podcast.
I really don't know how it's being received, but I did hear the author in the interview, and it sounded fascinating to me that they had it might have been the advent of really souping up Secret Service and watching the president, because there was this conspiracy.
Yeah.
So that's what I'm looking forward to
Cool.
this summer.
We'll off camera, I'll come back and check in with you and make sure it's a good read. So you're going to get it over Father's Day, you said?
I assume I am.
Oh,
I mean,
that's all right, Jamie.
Yeah.
Yeah. So, that's the book you're reading right now. In terms of, habits that you have, or little, one of these things you told me is that you're restoring like a 19th century house that over off Cape Charles, kind of the little gem of the Eastern Shore that until today not many people knew about.
Yeah, I have a 1916 American Foursquare that Jeannie and I purchased about 12 years ago. I'm not a handyman, but we've been playing with this home. It was a 10-year game plan. I'm now into 12 years.
Show me some pictures. It's
actually, I invited you to use it the one weekend.
is it and that's gone forever.
That's gone. Well, I don't know forever, but if we're not there, you're welcome to use it. So it just became our. It basically, I gave up all my 50s to that home. All my weekends and time. Everybody
Wow.
has hobbies, and
Yeah.
some like to golf and some like to fish. And we've always been living in Philadelphia and then in New England. We just got accustomed to history and old homes, and what we found neat about the Eastern Shore and Cape Charles in particular is this little town that kind of is like Americana with these old, Victorian and American homes, and we really found that quite charming. So we purchased one in late 2007. I was a nervous wreck when the meltdown happened in 2008.
Jeez,
whether
yeah.
I could pull this off with the second home in Richmond, and actually just moving down to Virginia in 2007. I actually had two homes in the state of Virginia, and I had just moved from New England. But it acted out, it felt right in my gut, and I usually go with my gut, and unfortunately I was correct.
So we'll close out with this then.
Mm-hmm.
Going with your gut, if you had one financial product that you had to buy, or you don't even have to buy, that's maybe not phrased the right way, but if there was one financial product that you could own, what would it be? You could only pick one.
Well,
And you don't have to say insurance.
Well,
What's-
it would be insurance,
And-
because when you
okay.
take all my financial products that I do have, I have more insurance contracts than I do annuities or portfolio. Most of my portfolio is in my qualified plan. So I think I have 4 insurance products, and of course I have one on my wife and I have one on my son. I did not buy one on my daughter, and she's going to now find that out right now. I just,
You are loved less, honey. I'm sorry.
but anyway, my son's is gone anyway. It doesn't matter. It would be life insurance of some nature,
Yeah.
and
And I know
as you
you're
know,
hedging here. I will put myself on the record of saying I would personally own and do personally own permanent, participating, dividend-paying, properly funded, whole life insurance, and I'm very unapologetic.
I'm
about
not. I'm not apologizing. I do. My first policy I ever purchased was just that, and
Yeah.
that's the one I still own today. And as I mentioned before, I did at the ripe age of 40 buy a huge term insurance contract that
Yeah.
it was levelized 30-year term, super preferred because I was at my peak, and it was dirt
your
cheap.
marathon days.
And
huh?
I will get rid of it, but it's so reasonable.
Yeah.
And then I have a permanent second to die contract on my wife and I.
Which means the death benefit doesn't get paid. Let's say if you pass first,
When-
nothing happens. No death benefits paid.
Right.
Your spouse or Jeannie would have to pass if it happened in that order,
Right.
in order for the death benefit to go to your heirs, your beneficiary.
And, I'm married to an Italian that's going to live forever, God willing. And I figured that she's going to outlive me. And the
Yeah.
strategy was that when we're both gone, there'd be additional cash so that my 2 children will keep the home in Cape Charles forever and ever and help them fund it and keep
Yeah.
it there. So that's what that's all about, in a sense of additional octane at the bottom of the ninth to keep that property that we've all enjoyed.
But there's an accumulation or buildup of
There is
cash inside this-
there is
yeah.
cash value in there,
Yeah.
so that if I ever needed to, I could. But the other additional thing is I have a permanent product that has, as we mentioned earlier, a chronic illness benefit on it for myself. But if I predecease Jeannie, I'd like her to have, or for my family to have a chronic illness benefit for her to access, and that second to die policy, in addition to providing the cash to maintain the vacation home on the Eastern Shore, it has a chronic illness benefit for her.
Which for listeners is like using, it's effectively like a long-term care rider, long-term care benefit.
Right. And
providing if you can't meet 2 of your 6 activities of daily living, and look at your provisions inside your contract to make sure it's
And I have never been a big long-term care fan. Back when I was in New England, I remember being at a meeting and publicly stating that I was not a long-term care fan because there is no guarantees in a lot of these products.
Oh, man, people have seen their premiums go through the roof.
Through the roof. And again, I'm not an actuary, but I knew that just innately that no, I don't want that product because there's no guarantees. And I've seen contracts in the life insurance industry that self-destructed because of the lack of guarantees. I wasn't about to. That's typically a market you're going to promote to more of a mature clientele, and no sooner than you sell it to them and you're starting to pull the rug out from under them. So I really love the chronic illness benefits that are available today in your permanent policies.
Something consumers should look at for sure.
Right, exactly.
Yeah, so sake of time today and boring people to death with life insurance conversations, let's get you back one day, man. We'll have a conversation again. And there's an actuary, I don't want to say his name yet or put him on the hot seat, that I know at a very large mutual carrier, that I asked him that question. I asked you if there was only one financial product that you could own, which would it be? And which would you give your mother? And his answer to me was a properly funded whole life insurance contract. And this is a designer of contracts. I'm going to put him on the hot seat and make him say that. Not make him, but ask him to say, hey, why? And let's talk about that from an actuarial point of view of why you would pick that product in your process. Not to say that all of these other choices are bad or some are just indifferent. But from the features and the benefits that are provided in those contracts, I would say that would be a pretty strong statement coming from an actuary to say that that's his product of choice is a participating whole life contract that's properly funded. So if you want to know more about how to do that, follow the links inside the podcast here, and we'll link you up with some folks who can help you with that, including on my side in my firm. Mike's also someone who helps in the business, so we'll give the ability for you to contact Mike. We'll put your info on the website. And we'll put the link to Conspiracy of Lincoln. That sounds like an exciting read. That especially
I think it's going to be interesting.
Yeah.
I mean, I don't ask for many books, so that one caught my attention, and I don't know. I think that's going to be a nice read for the summer.
Awesome. Well, look, hey, thanks so much for taking time out of your day to come hang out with me. I hope your family are proud of you when watching this podcast, and I know your son was giving you some.
I'm sure I'll get some jokes about me.
Yeah, tell him to come see me. We'll chat with him.
Well, I think
we'll put him on the hot
I
seat.
One of your associates before we came in here that I was actually asked to do a TV program probably about 15 years ago where you can rent time and video and then be on at 11:30 at night and talk about, and that thing never aired. So,
what?
Well, I assume I didn't do a great job.
Did you have your clothes on?
I don't know. He was. I think he focused more on medical underwriting during that program, and I think that was
11:30 at night. Who decided that program?
I think that might have been a little boring, and
Yeah.
But I don't know whether this is boring or not. But I hope.
I enjoyed it, and we're going to put
fun.
it out there for people to listen to and watch. And if they get something of value from it, they'll be able to tell us. And if they hated it, you can tell us that in our feedback as well. And if I get feedback that they hated it, I'm going to be sure to let you know.
Yeah, I'm sure you will.
Yep. So hey, look, cheers to you.
Thank you,
family.
Kenny. I'm flattered you even asked me to come in.
God bless you. I drank all my Johnny, but thanks for buying this for me last year. And you can see I'm Every podcast I do a little thing
Well-
here, and all of my guests so far, I beat them to the punch. While you're gabbing, I'm over here getting sauce. So
Well, I never had Blue Label until I met you.
what?
No, I never did. And you ordered it that one time in Maryland.
Yeah,
And you turned me on to it.
it's my poison. I
was
don't
always
drink
a
much of it.
I was a Jameson guy. I still drink Jameson, but Blue Label is very, very good.
Johnny Walker Blue Label. You heard it here. So, hey, Johnny Walker, there you go.
There you go.
We are plugging the crap out of you guys today.
yes.
Show us some love.
There you go. All right,
hey,
thank you for having me.
it was awesome having you. Hey,
right.
best to your family.
Thank you. You too. Bye-bye.